Hello friends, welcome to this wonderful accounting standard again. So our next topic is benefits paid. Benefits paid means whenever the payment is made to the employee, how to pass the entry for that. So whenever benefits are paid, journal entry would be benefits paid account debit to bank account. Benefits paid account debit to bank account. This is the entry for benefits paid, and to that extent we are going to reduce the liability. To the extent we are going to reduce the liability, the entry will be PV of DBO account debit to benefits paid, or you can pass one entry. You can directly pass one entry if you want, PV of DBO account debit to bank account. Good student can write that also. PV of DBO account debit to bank account. Is it right? So these entries are passed whenever the employee is paid, either for at the time of retirement or after the retirement, or in case of long-term benefit plan, whenever the benefit is paid in case of long-term benefit plan. Okay. Second point to be noted is that it is always assumed that payment of benefit, for payment of benefit, entity will use plan asset if available. So first priority we will give to plan asset. Plan asset means investment which we have made. If we have made some investment in a fund, in a trust, or in a government scheme, or in insurance company, then it is assumed that that plan asset or that investment will be first used to make payment to the employees. But if that is in case of funded liability, in case of non-funded liability, we will assume that the payment is made from your existing bank balance. Okay. Now next is accounting treatment of plan asset. Some companies are prudent companies. They fund their liabilities. So what these companies do, this company will make investment, and those investment made in any trust or a fund or an insurance company or with a state plan, we are going to call it as plan asset, which is nothing but investment made. When the employee will be retiring, investment will be sold and payment will be made to employees. That is how the scheme works, will be made to employees. So now how do the accounting will be done? So students should understand that the first company will have to make investment. Company will earn some return on that. Then the employees will be paid out of the plan asset. So all these entries we have to learn, right? So following entries will be passed. Following entries will be passed. Whenever the contribution is made towards plan asset, the entry will be plan asset account debit to bank account. Plan asset account debit to bank account. And whenever the benefits will be paid to employees, benefits are paid to employees when he retires or after retirement, we will assume that plan asset will be used to settle the liability. Bank account debit to plan asset. That is, you are going to first sell the plan asset. You are going to sell the plan asset. What is the entry? Entry is that you have sold the plan asset, you have raised the money, and that fund will be used to pay the liability. Next entry is for expected return. Sir, what is expected return? You are making investment, so you are going to record expected return on plan asset. That is the rate of return the plan asset is expected to generate. This is given by the actuary. The actuary makes an estimation of the expected return. Entry will be plan asset account debit to expected return. Plan asset account debit to expected return. Just like it is like entry for interest accrued. It is like entry for interest accrued. Suppose your parents have invested in a bank FD. At the end of the year, the interest will accrue. So your parents will increase the value of FD because the interest has accrued, and to interest income on FD. This is how you will pass an entry for interest income on FD which has accrued, but you are not receiving the payment now, you are receiving the payment later. Okay, so that is the entry for expected return. Then at the end of the year, we are going to compare book value with fair value. At the end of the year, we are going to compare book value. Book value means the net effect of these three entries with the fair value of the plan asset. Fair value is market value. Now there are three possibilities. Fair value is more than book value. This is called actuarial gain. Fair value is less than book value. Then this is called actuarial loss. And fair value is equal to book value. No actuarial gain or loss. No actuarial gain or loss. If they are equal, it means actuary's assumption about expected return was correct. Is it right? Most of the time in the exam, you will get either the first or the second situation. Okay, and suppose there is an actuarial gain. Fair value at the end is more than book value. We will call it actuarial gain. Entry plan asset account debit to actuarial gain. And this actuarial gain will be recorded in profit and loss account. This will be recorded in profit and loss account, and the value of the plan asset will increase in the books of account. If there is a loss, loss means fair value of plan asset is less than book value, then it is a loss. You will reverse the entry. You will reverse the entry means the entry will become, I will write it, if you are interested you can also write, actuarial loss account debit to plan asset. Actuarial loss account debit to plan asset. Okay, we are going to reverse the entry. If plan assets are used for curtailment, point number 5, I hope the student remember curtailment in the previous lecture. If the plan asset is used for curtailment, that means if the payment is made at the time of curtailment, you are going to again record the entries like the above. If the plan asset is used for curtailment, you pass entries just like benefit paid entry we have done just now. Okay. Now the student will have to write a note in the notebook. Are you going to write a note in the notebook? Please write. Please write a note. Write down in the notebook. Note on expected return on plan asset. Note on expected return on plan asset. Under that write down, it is actuary assumption. It is actuary assumption regarding. It is actuary assumption regarding. It is actuary assumption regarding the rate of return. It is actuary assumption regarding the rate of return expected to be realized in the current year. It is the actuary assumption regarding the rate of return expected to be realized in the current year. Okay. Second line, such return is due to profit or loss on sale of investment. Such return is due to profit or loss on sale of investment. Second, write down interest income or dividend income. Interest income or dividend income. And third, write down expense on plan asset. Third, write down expense on plan asset. Okay, so this is how expected rate of return will be calculated. In your exam, they will give you this is 9, this is 2, this is 1. So you will say the expected rate of return is 9 plus 2 minus 1, 10%. If it is given. Okay. Then next, write down what is the treatment of expected rate of return on opening plan asset. On opening plan asset. Just like you have recorded interest cost on opening liability, you are going to record expected return on opening plan asset. On opening plan asset, the expected rate of return will be multiplied to find the expected return which will be recognized as income by debiting the plan asset. So the entry for expected return, actually we have already written above. If you see point number 3 above, we have already written the entry. Still you can write plan asset account debit to expected return on plan asset. So the calculation will be opening balance of plan asset multiplied by expected rate of return. It is like you are recording income on investment. This is your investment and this is your income. The entry for income on investment is investment account debit to income on investment. So investment value goes up and the interest income or income on investment is recorded in profit and loss account. So this expected return, where will you transfer this expected return? This expected return will be transferred to profit and loss account. Expected return will be transferred to profit and loss account. Next point, write down. One very important point, write down. Expected return is calculated on half yearly basis. Underline. Expected return is calculated on half yearly basis. Expected return is calculated on half yearly basis. That means compounding is done half yearly. This is half yearly compounding. Suppose this is 1st April 2025. This is 31st March 2026. So expected return will be first calculated after 6 months. So you have suppose 100 rupees and the expected return for 6 months is 5%. It will become 105. Then again after 6 months, you will earn 5% on 105. So that will become, let us calculate 105 into 1.05. So 110.25. So don't take 10% directly. You will have to take first 5% for 6 months and then on the revised amount again 5% for 6 months. So effective return would be 10.25%. If you are getting 5% every 6 months, the effective return would be 10.25% per annum annual compounding. Second note, write down, given return is always annualized return. So the institute would give you 10.25% per annum, which means it is annualized return they have given. it is annualized return they have given. But for you, the calculation has to be done every 6 months. Then you have to find effective return for 6 months. You have to find effective return for 6 months. Sir, how to compute effective return for 6 months? The formula is, you may have studied in mathematics also, equal to under root 1 plus annualized return. This is under root minus 1. So if you are given annualized return, you can find out the return for 6 months using this formula. I will show you. Otherwise you are not going to get convinced. Write down. For example, if the annualized return is 10.25%, find the effective return for 6 months. Find the effective return for 6 months. So you will write effective return for 6 months equal to under root 1 plus annualized return is 10.25%. I will write 0.1025 minus 1, and you can check yourself, it is 5%. And this is the proof. You can write the proof also. If you have 100 rupees at the beginning, if you earn 5% after 6 months, we will have 105, and again after 6 months we will have 110.25. So this is the proof that if your annualized return is 10.25%, your effective return for 6 months is 5%. So proof in front of you. Let us solve few questions. They will ask you very basic question on plan asset. Very easy. Just like accounting of investment you do it here. Question number 23. The following data applies to X Limited. Defined benefit pension plan for the year ended 31st March 2002. Calculate the annual return on the plan asset. So you have to always find out what they want you to compute. They want you to compute the annual return on the plan asset. Benefit paid is given, employer's contribution is given, fair market value of plan asset on 31st March 2002 is given, that is closing balance, and fair value on 31st March, that is opening balance. Now there are two ways I can do it for you. One is I can prepare a ledger. That is plan asset account, which you will also write in your notebook. Is it right? So that you will understand the different ways of understanding the same question. This is your opening balance. So you will write on the debit side, plan asset is an asset, it's a debit balance. Any asset has a debit balance to start with, 8 lakh. This is opening balance. And somewhere on the right credit side, buy balance carried down. This is one way of understanding which you can follow in the exam. No harm. You can follow this in the exam. 11,40,000. And then they have written benefit paid. That means plan asset was used to pay benefit to the employees who have retired. Plan asset was used to pay benefit to the employees who have retired. An employer has contributed. This year we have made more contribution in the plan asset. To employer contribution, is 2,80,000. Okay, to employer's contribution 2,80,000. Now we'll take the total of the credit side first, that is 13,40,000, and on the debit side 13,40,000 minus 8 lakh minus 2,80,000. So there is a difference of 2,60,000. So this difference is the actual return. The difference represents actual return on plan asset, and that is how you get the answer. This difference represents the actual return on plan asset. Okay, done. We can solve by one more way. So I'm going to erase it. First you check you have done it. Okay, now I'm going to erase it. There is one more method, just apply mathematics. Alternatively, closing plan asset is equal to opening plan asset plus employer's contribution plus actual return minus benefits paid. Opening balance, add contribution, add return, minus benefit paid is closing plan asset. So now we'll have to write 11,40,000 is equal to opening is 8 lakh, further contribution made 2,80,000 plus actual return, which is the balancing figure, minus benefits paid 2 lakh. Minus benefit paid 2 lakh. Okay, and when you solve it, actual return will be equal to 2,60,000. Actual return will be equal to 2,60,000. So this is how the relationship is there between opening and closing plan asset. I hope you have noted down both the answers. In your book also the answer is printed, which is similar thing. They have just presented in a vertical format, and if you want to prepare later you can prepare like this. Now we'll take question number 24. Question number 24. 24. Very important. Very important question number 24. The fair value of the plan asset. The fair value of the plan asset of Anupam Limited was rupees 2 lakh. In respect of employee benefit pension plan on 1st April 2001. So this is my opening balance. On 30th September 2001, plan paid out benefit of 25,000. So date underlined 30th September, payment made 25,000 and received inward contribution of 55,000. So on 30th September, 55,000 was contribution, 25,000 was benefit paid. So net addition to the plan asset was 30,000 rupees. So on this 30,000 we will compute expected return only for 6 months. Whereas on the opening balance we are going to compute the expected return for 12 months. Now they are saying on 31st March 2002 the fair value of the plan asset was 3 lakh. So this is closing balance. On 1st April 2001, the company made the following estimates based on the market value and the prevailing prices. So what are the estimates made by this company? Dividend and interest income will be 10.25%, realized gain will be 3%, expenses on administration 3%. So your expected rate of return is 10.25%. Calculate the expected return. This time one more question. Compute the expected return and actual return on plan asset on 31st March 2002 as per AS 15. As per AS 15. Now in this problem, we have to compute one more calculation called expected return. Now you will have to understand, at the beginning we had 2 lakh rupees in the plan asset. Then on 30th September, middle of the year, 30,000 rupees was added to the plan asset. So we are going to compute on the opening balance, we are going to compute for 10.25% because it was for 1 year. But on this, we are going to compute expected return for 6 months. This 10.25% is annualized return. We have to find out the effective return for 6 months. We have to find the effective return for 6 months. Effective return for 6 months will be calculated by applying a formula. So write down please. Calculation of effective return for 6 months. Calculation of effective return for 6 months. Calculation of effective return for 6 months. Under that, write down effective return for 6 months equal to 1 plus annualized return minus 1 under root 1 plus annualized return minus 1. Write down. Annualized return is 10.25%. Effective return for 6 months equal to under root 1 plus 0.1025 minus 1, 5%. This we have already done as an example. Okay. Now we'll solve this question. In this question, our first task is to find out expected return on plan asset. Please write down expected return on plan asset. Expected return on plan asset on 31st March 2002. On 31st March 2002, as per AS 15, we have two numbers. One is opening balance, on which we are going to compute for full year, and second on the additional 30,000 which came on 30th September, on which we are going to compute for 6 months. So please write down first point A. First point A, write down return on opening value of plan asset. Return on opening value of plan asset of rupees 2 lakh. Return on opening value of plan asset of rupees 2 lakh held for 1 year. Held for 1 year. Held for 1 year at the rate 10.25%. 10.25% into 2 lakh. 10.25% into 2,20,500. 20,500. Then write down next add return on net gain of rupees 30,000. Net inflow you can say, net addition to plan asset. Return on net addition to plan asset. Return on net addition to plan asset of rupees 30,000. How this 30,000 has come? 55,000 minus 25,000. 55,000 minus 25,000 during the year. That is held for 6 months. That is held for 6 months. At the rate 5%. Now this 5% working we have done at the rate 5%, equivalent to 10.25% annually, compounded every 6 months. Compounded every 6 months. Equal to 10.25% compounded annually every 6 months. And write in bracket refer step 1. Refer step 1. So that is coming to 30,000. 30,000 into 5%. 30,000 into 5%. So therefore expected return on plan asset. Therefore expected return on plan asset. Therefore expected return on plan asset is 22,000. Add these two numbers. Expected return on plan asset 22,000. Now the next question is computation of actual return on plan asset. This is printed in the book. Just check it from there. Expect actual return on plan asset on 31st March. This is institute answer. Closing balance is given. Opening balance is given. Contribution is given. So total 2,55,000 and add benefits paid 25,000. So that is actual return 70,000. We can write like this. We can write like this. Write down. This is our way of solving. Closing plan asset equal to opening plan asset plus contribution plus actual return minus benefit paid minus benefits paid. Closing plan asset is given 3 lakh. Opening plan asset is given 2 lakh. Plus contribution from employer 55,000 plus actual return minus benefit paid 25,000 minus benefit paid 25,000, and therefore when you solve this equation, the actual return is equal to 70,000. The actual return is equal to 70,000. The actual return is equal to 70,000. This way also you can solve. This way also we can solve. Okay. Now add one more question. Add one more question in your notes. Calculate actuarial gain and loss. Calculate actuarial gain and loss. Calculate actuarial gain and loss. Now what do you mean by actuarial gain and loss? Actuarial gain and loss means the difference between what was expected and what actually you earned. So you have understood Actual return is 70,000, but the expected return was only 22,000. Therefore, the actuarial gain is 48,000. Write down please. If they ask you, they can ask you what is actuarial gain and loss. Student will say actual return 70,000, actual return 70,000, expected return on plan asset 22,000. Therefore actuarial gain is equal to 48,000. Therefore actuarial gain is 48,000. And now you prepare plan asset account. Suppose they ask you to prepare plan asset. Add one more question. Prepare plan asset account. Add one more question. Prepare plan asset account. Add one more question. Prepare plan asset account. Write down. To balance brought down 2 lakh. This is extra work we are doing for understanding purpose. If you are interested, you should write. If you are not interested, still you should write. To balance brought down. Opening balance. To bank. This is contribution. Employer's contribution. To bank 55,000. To expected return 22,000. This is step 2. Then write down by bank benefits paid 25,000. By balance carried down closing balance 33 lakh. So the balancing figure is actuarial gain. Balancing figure is actuarial gain. To actuarial gain balancing figure. Okay. So all of you have understood actual return is equal to expected return plus actuarial gain. So instead of writing actual return, this time I have written 2 items because actual return is equal to expected return plus actuarial gain. Previous problem they had only asked actual return, so balancing figure will be actual return. But if you have written expected return also, then the balancing figure will be actuarial gain. And if the difference is coming on the credit side, that is called actuarial loss. Come to question number 25. Write down as homework. Question number 25. Please mark it as homework. There is nothing new in that. Question number 26 now. Question number 26. On 1st April 2008, the fair value of the plan asset was 1 lakh in respect of pension plan of Zealous Limited. On 30th September, same problem again. 30th September underline, the plan paid out benefit of 19,000 and received contribution of 49,000. So your net inflow is, again the answer is 30,000. 49,000 minus 19,000. Opening balance is 1 lakh. Then on 31st March, fair value of plan asset is 1,50,000. This is closing balance. Figures are similar to the previous problem. And the present value of defined benefit obligation, this is liability. Is 147,920. Actuarial loss on the obligation, this again on the liability, is 600. Unnecessary information, these two lines are unnecessary information to confuse the student. Then on 1st April 2008, company made the following estimate, etc., etc. Interest and dividend income 9.25%, realized and unrealized gain 2%, administration cost 1%. So your expected rate of return, this is annualized, write down, is 10.25%. And in the previous question I have already done. So the effective return for 6 months will be 5%. Effective return for 6 months will be 5%. You are required to find out the expected and actual return. Write down homework and don't do anything as far as this portion is concerned. This is to confuse you, because we are not required to do anything with respect to liability. Remaining portion is same. Just take my previous example and solve one by one. First, compute expected return. On the opening balance, take 12 months. On the additional 30,000, take 5%. And then you compute the actual return, which will come to 20,000. And if they ask you actuarial gain, the difference between 20,000 and 11,750. Okay. Come to question number 27. Write down homework. Same problem I have done. Question number 28, write down homework. Same problem we have done. Just more practice from different sources. Question number 28, homework, and question number 29 is also homework. Okay. This is similar to our question number 26 and question number 24. So today you have lot of homework to cover, but all questions are same and all questions have been taken from your study material, RTP, MTP and exam. Now we'll come to one theory question number 30. Question number 30 is a theory question, 30 theory question taken from study material. A company has a scheme for payment of settlement allowance to retiring employees. So this company pays settlement allowance when the employee will move to another city on retirement. There are some allowances paid for that. Okay, because it may be very expensive to move from one location to other. The employee must have worked for several years at a very distant location, right? Now it says, under the scheme, the retiring employees are entitled to reimbursement of certain travel expenses for class they are entitled to as per company's rule, and to a lump sum payment to cover expenses on food and stay during the travel. So this is what will be paid to them as settlement allowance. So one option is they will get amount of reimbursement. Okay. Second option is employees can claim a lump sum amount equal to 1 month last pay drawn. One option is based on what you incur, you will be reimbursed plus some lump sum amount for food and stay. The other option is, don't take this option, you can choose to receive 1 month pay equal to last salary. So your whatever is your last salary, equal to that will be paid to you. But this will be paid on retirement. How much will be the last drawn pay will be known only at the time of retirement. Company has committed to make this payment. So this is a defined benefit obligation plan. Unless the company makes this payment to the employee, the liability doesn't come to an end. Now what company is saying? Company's contention in this matter are settlement allowance does not depend on the length of the service. It is restricted to employees' eligibility under the travel rule of the company, or where option for lump sum payment is exercised equal to last drawn paid. So company says it does not depend on length of the employee. Either he will get as per rule or as per last salary. Since it is not related to length of the service of the employee, it is accounted for on claim basis. It is accounted for on claim basis. So that means they don't want to make a provision. Company is not interested in making provision for this settlement allowance liability. State whether the contention of the company are correct as per accounting standard and give reason in support of your answer. So company's contention is not right. Oh my God. So first answer is not right. It is a defined benefit obligation. Company should make provision. Company should make provision. Okay, using actuarial valuation. Because what would be the last drawn salary? We don't know. His age is 30 now. He will retire at the age of 60, and you have to pay him an amount equal to 1 month of last salary. Because he is rendering service today, he is entitled to receive the settlement allowance in future. So this give rise to defined benefit obligation, and the company should consult an actuary and make appropriate provision. Otherwise, in some companies there are lakhs of employees, and to lakhs of employees you will have to give this settlement allowance. It will give rise to a huge liability towards the end. Okay, so we cannot follow cash method of accounting, because company says when he will retire we will pay him an amount at that time and we'll do the accounting. That is cash basis of accounting. We can't do that. We have to follow accrual basis of accounting. Now on homework, write down, I have made a small table in your book, comparison between defined contribution plan and defined benefit plan. In defined contribution plan, the employer's obligation is limited. The employer's obligation is limited to the extent of contribution. In defined benefit plan, the employer obligation doesn't come to an end. Accounting of defined contribution plan is simple. Accounting of defined benefit plan is complex. Normally in defined contribution plan, discounting and actual valuation is not required. Whereas in case of defined benefit plan, discounting and actual valuation would be required. In defined contribution plan, the risk is with the employee, whereas in defined benefit plan, the risk is with the employer. So that summarizes your defined contribution plan and defined benefit plan. I hope you liked it. Okay. Now my next task is other long-term employee benefit plan. You write down, similar to post-employment benefit plan, what we discussed in the last two lectures, accounting for long-term employee benefit plan are also same. Examples we have already covered, like long-term compensated absences, already discussed on the in the first lecture. Jubilee or other long-term service award, long-term disability benefit, profit sharing and bonus if they are payable more than 12 months from the balance sheet date. What about the accounting treatment? Printed in the notes. No need to write. I have just converted the statement into tabular format. if the other long-term employee benefit plan are defined contribution plan or DCP, defined contribution plan, good news, it will be treated like we have treated in the case of post-employment benefit plan. No difference. Whatever we have done till now applies for a defined contribution plan, which is a long-term employee benefit plan. Here the benefits are payable after 12 months but before retirement. And one more good news, if the long-term employee benefit plan is a defined benefit plan, it will be treated like post-employment benefit plan. So there is no major difference. But there is only one small difference, that is the presentation in the balance sheet. In case of defined benefit plan under post-employment benefit plan, in case of defined benefit plan under post-employment, we had three items in the balance sheet. One is present value of defined benefit obligation. It is here also. Minus fair value of the plan asset. It is here also. But in case of defined benefit plan under post-employment benefit, there was one more item, minus deferred past service cost. In other long-term employee benefit, we do not have deferred past service cost. So you can mention we do not have deferred past service cost in long-term employee benefit plan. All past service costs are charged to profit and loss account. In case of other long-term employee benefit, all past service costs are charged to P&L account. They are not carried forward because it is believed that this amount will not be very material. It will not be material. So all past service costs are charged to P&L account irrespective of whether vested or unvested. Okay, even unvested past service cost will be transferred to profit and loss account, right? So this is about other long-term employee benefit. Then we'll come to the last part, termination benefit. Termination benefit is paid when before the normal retirement, either the employer will ask the employee to leave the organization before normal retirement date, or the employee takes voluntary retirement, or the employee takes the voluntary retirement. Is it right? Or the employee takes the voluntary retirement. Now the question is, what is the treatment? The treatment is, if you are going to make any termination benefit payment, you will make a provision for it. You will recognize expense and simultaneously make a provision for it. But then there are few conditions to be satisfied. You will recognize a liability and corresponding expense if following conditions are satisfied. So for exam purpose, keep in mind there are conditions. A detailed formal plan. So entity has made a detailed plan in writing, formal plan, that is approved by the respective management, whosoever is responsible for taking decision has approved it. A detailed formal plan for termination which is duly approved. And second, a reliable estimate can be made. Reliable estimate means how much amount will be payable as termination benefit to the employees who are going to retire. So now what I have done to simplify for you, in your book there is a long lengthy paragraph and I have made a summary for that. So in case if you want, you can take a snapshot and you can write it later. You can pause the video and then you can write. But I am not going to give you right now the time to write down. Everything is printed in the book. You can see when the termination benefits fall due within 12 months after the balance sheet date. If it is fall due within 12 months, then you will not supposed to discount it. First point, do not discount because it is less than 12 months from balance sheet. You will recognize a liability in the balance sheet. You will recognize the expense. Full termination benefit expense will be transferred to profit and loss account. Second is when the termination benefit fall due more than 12 months after the balance sheet date. As you can understand, if it is more than 12 months after the balance sheet date, then we have to discount it using appropriate discount rate. Third is where an offer has been made to encourage voluntary redundancy. Company has asked the employees, those who want to leave can leave. Then termination benefits should be measured by reference to number of employees expected to accept the offer. So where the company has made an announcement of VRS scheme, make provision by estimating how many employees are going to accept VRS. So you have 5,000 employees to whom VRS is offered and you think that 2,000 employees will opt for it, make provision for 2,000 employees. And the last point is printed in the book also, where there is uncertainty with regard to number of employees who will accept an offer of voluntary redundancy, where there is uncertainty. We don't know how many employees will opt for it. There is an uncertainty regarding number. Then we can create a contingent liability because I don't know whether the employee will accept or not, how many of them will accept or not. So we can create a contingent liability as per AS 29. And the last point is journal entry for termination benefit. We will have to create one liability in the books. What entry do we pass when we have to create a provision for termination benefit in the book? We will pass an entry employee benefit expense account debit, and this goes to P&L account. To provision for VRS, this goes to balance sheet. Liability side, either current liability or non-current liability depending upon when the liability will be paid, depending upon how the liability or when the liability would be paid. If the liability would be paid within 12 months, then we will call it current liability. If the liability is payable more than 12 months, then we'll call it as a non-current liability. So this was about this amazing and very wonderful accounting standard 15. We have tried to simplify it to the extent possible for you, and I hope you have enjoyed this topic on AS 15. Thank you very much and see you again.